Hi, Filip. Thanks for joining me today on this podcast. And I wanted to ask you some questions about insurance and life insurance. It was really exciting that we met during a mastermind, and I love what you're doing and how you're helping people create generational wealth. So
Great. Yeah, thank you so much for having me. I'm so excited to answer any questions and bring some clarity to the idea of generational wealth.
awesome. So when I started my business, I was thinking about what do I need to do to create long-term wealth. So the first question I had for you is, could you give me an overview of the indexed universal life insurance and actually the importance of creating generational wealth?
Yeah, absolutely. So just to kind of get started a little bit, I own an insurance agency for about 22 years. I've been in the insurance space, and we've helped thousands and thousands of people make these kind of decisions on what they should do with life insurance. There's so many different variations of life. There's whole life, there's term life, and there's universal life. These are the three main kinds of life insurance. There's all these different purposes that you use life insurance for. So a lot of terms get thrown around, but really there's only three kinds of life insurance: whole life, universal life, and term life. And universal life is a bridging between whole life and term life. Originally, there was only whole life and term, and then came out universal. And what universal life really means is that you have a portion of your life insurance, the portion of the premiums that goes into the death benefit, and then a portion of the premiums that goes into cash value. You see, if you're ever on hard times with life insurance and you don't make the premium, if it's not paid, means that your policy will be canceled. And that's a terrible thing, right? Because a lot of times in whole life, for instance, you're paying $1,000 a month for your entire life. But what happens if your economy goes bad and you need to save money because you got to pay your bills or feed your children and you can't make that life insurance payment? All your money goes away and now you lose that policy. So universal life was a way to kind of correct that. And with universal life, what happens is, again, a portion of it goes into cash value and another portion of it goes into the actual premium to pay for the life insurance. So if it's $1,000, and I'm just using round numbers here, if it was $1,000, you had 500 going into cash value and 500 going into the life insurance. If you couldn't make the $1,000 payment, that's fine. All you have to do is make the $500 life insurance payment just on the life insurance part, and your policy stays intact and you don't lose your cash value, you don't lose your death benefit. An IUL is an indexed universal life policy. So it's a universal life policy that allows you to separate the premium for life and the premium for cash value, but it attaches to an index like the S&P 500. Now, there's a lot of different indexes that exist within the stock markets, the Dow and all that stuff, or you could do a pace setter. But most popularly, people are going with the S&P 500, the Standard & Poor's 500, which is the 500 largest, most successful companies in the United States that are trading on the S&P 500. And because that's going on, the market sees ups and it sees downs. In an indexed universal life policy, you only take advantage of the ups of the market. And if the market goes down, the lowest you can make is 0%. So your money's protected inside an IUL, an indexed universal life policy. And it's a really important piece of the puzzle when you're trying to grow generational wealth, because there's different parts of investing, right? You have investing that you go to a financial planner and they put you in special stocks, or they have certain things that are pre-IPO that they can put you in. They know something or they know somebody. I'm not talking about insider trading. I'm just talking about they're ready to look at trends and know where things are going. Or there's mutual funds and ETFs and all those things. I don't do any of that. That's on someone else. Those are 401ks, IRAs. Those are limited on how much money you can put in them. Now, those are great investment vehicles, but an IUL is built for mitigation of risk. You're really avoiding risk of a downturned market and protecting certain amounts of your money. So that's really where the generational wealth comes into place, because what it's for is it's a great way to build for the next generation, for your kids, your grandkids, your great-grandkids, or anybody that you want to leave money behind. Maybe you want to start a scholarship or a fund for students somewhere from some school that you went to, and you want to have this fund that lasts forever. A great way to do that is with life insurance, and the IUL is a phenomenal way to build that wealth within a policy.
Well, thanks for explaining that. I have no idea the differences between different insurances. So I think you did a great job explaining that.
Thank you.
And so why do you feel like it's important for people to have that type of insurance?
Yeah, I think it's important that like when you're looking at investing and you're looking at what you want to do with your money, I think it's important that you don't want to keep all your eggs in one basket. And there's far too many people that are on social media that are saying, hey, ditch all your other investments and just put all your money in an IUL. Absolutely not. That's not what I suggest. Again, I think IUL is part of a larger strategy. I think it's a great way, again, to grow wealth, compounding interest that's going to grow tax-free, that you won't have any downsides in the market. So if the market goes up, you get a portion of the upside of the market. The market goes down, you don't participate in the negative parts of the market, which is great because over time, the S&P 500 over the last 50 years has averaged somewhere in 7.5%. So at a conservative standpoint, we show about 6.4% of interest gained year over year on an average to show people base numbers. But that's compounding interest because it's tax-free growth. So you're not paying capital gains tax on it, so it grows much faster. Einstein once said that the eighth wonder of the world is compounding interest, and I'm a firm believer in that. Compounding interest is something that's beautiful. And when people look at it at first glance, like, well, 6.74% isn't a lot of percentage. And I'm like, it is when you're not paying enormous fees, you're not paying percentages to the person who's running the fund, and you're also not paying any capital gains taxes. And when you draw out the money, you're also not paying taxes on the money when you draw it out. So there's a lot of benefits to an IUL and how it can actually work for you in the next lifetime, your kid's lifetime. But also during your lifetime, you can have great access to this money in the form of loans where you can borrow against your own policy as like a bank. You can treat it like a bank account. You borrow against the policy, you pay a fee. So let's say that the fee that you pay to borrow from the policy is 3%. If you pay 3% to borrow your own money and you're gaining 6.4%, 7% on the back end, that means you're making money off the money that you're borrowing. This would never happen in a bank. This would never happen with an IRA or a 401k. This only happens through the life insurance vehicle. And that's where IULs are super pivotal and strong when you're adding it to a strategy for investing. What do you want to risk? Whatever it is that you want to risk, give that to a financial planner. They're more than happy to lose it for you. And most will, right? Because they're just going to put you in something, turn around and ignore it, especially if you're under $1 million. If you're not a vetted person and you don't have over $1 million net worth, I'm a firm believer that most of these financial planners that are all the way up there are not really paying attention to you, nor will they probably do business with you because you're not qualified. So they look at that and they say, we're just going to put it in there and let it sit. That's a dangerous thing. I think you know as well as I do, money likes attention. Money likes action. Money doesn't like to be ignored and shoved into a dark corner unless there's specific guarantees. And with IULs, you get those guarantees where you won't lose your money. You can either hit zero or make gains. And in this case, zero is your hero.
Great. Thanks so much for explaining that. That makes so much more sense to me now. And so how can it assist in long-term care costs? Because we work with a lot of clients who have diseases and oftentimes they can't afford healthcare. So how can it assist people in healthcare?
Oksana, I think that's a great question. And what it really comes down to is a lot of people, and I run into this a lot because we have a health insurance part of of my agency as well. And we run into a lot of people that are always like, well, I'm healthy, I'm good, I don't need health insurance, I take care of myself. And I said, that's great. But what if something were to happen? If you were in a car accident and you became paraplegic and you had to be in a nursing home for 10 years, who's paying that bill? And most people are like, well, the car insurance will pay that bill. I said, no, you're going to get a claim and the claim is going to pay a portion of the bill, but you're talking about long-term care. Who's going to pay that bill? Or you fall off a ladder and you crack and you break your back, or you're riding a bicycle and you fall off and hit your head and you're comatose, right? And your loved ones want to keep you alive for years and years and years. Who's paying that bill? That becomes a big problem for people because most people think that I'm going to end up in the nursing home because I'm sick or dying. No, you can get it from dementia. You can get it from Alzheimer's. Now, there are ways to avoid having those things done, but a head trauma can bring on dementia. It can happen, and it's just a bump of the head. You're totally clear. You know what's going on. You bump your head hard. Your brain hemorrhages. It just doesn't replace the way it did, and all of a sudden you're losing memories. You're getting different problems. Then it onslaughts into dementia, and you're sitting in a nursing home. So many people forego it when they're healthy. it is a great idea to get a product like an index universal life when you're healthy, because not only does it grow that generational wealth and it has that factor where you can make money off of it and borrow against it, it also has something called living benefits. And living benefits is exactly what you're asking about. Living benefits are ways that you can access the death benefit while you're still living for critical illness, chronic diseases, dread diseases, and long-term care, as long as you have lack of 2 of the 5 common facilities, like you need help with your incontinence and you need help eating, right? Things of that nature. If you qualify for those 2 things, whichever one it is, just 2 of them, then you can access your death benefit up to like 98%, depending on the policy. Some are at 90%. Every policy is different. But depending on the policy, on average, you're going to get about 90% of what the death benefit is. So if you had a IUL, an index universal life policy, and the death benefit, let's say, was $1 million, and you were able to access 90% of it, that means you'd have access to $900,000 to help you pay for your nursing home expenses or long-term care expenses. It's absolutely important that when people are healthy and they're younger, they take advantage of this, because they can grow a massive amount of protection to help protect themselves if they get older. And the best part of it is this: if you were to die, right, and never use the long-term care, your beneficiary gets all of that death benefit money and the cash value. So there's no downside to having one of these kinds of policies. The only downside is the mental idea of, hey, I've got to pay for something that I can't necessarily hold in my hands. We love tangible items. We like to buy things and then wear it, buy things and then put it in our hair, whatever, right? Buy things and wear it on our wrist. But we never think about the things that we purchase, right? Because you can't buy good health. You can't. But you can buy amazing therapies and amazing workout programs and amazing books and amazing diets. You can buy these things. They're not tangible, but if you do them consistently and constantly, you're going to live a healthier and happier life. But even the healthiest and happiest people go through seasons where things aren't so great. And I think you see that all the time, because you're dealing with people that all of a sudden something happens to them. They're like, I don't know what to do. I don't know what to do. My immune system is shutting down. Things are going on. And then you go in with the scientific approach and say, hey, listen, these are the things that we can do to help you reverse all of this, right? So you stare at this stuff in the face every single day. And if people just were more in tune and knowledgeable to that factor, the untangible thing that can help you, I think they'd be way better off. So that's really how it comes into play and helps you with long-term care.
Great. Thanks for explaining that. So, well, when you have a conversation with someone and they never had any type of insurance, you would be able to help them, give them the best recommendations for them, for their specific case, and as well as the finances they have available. Is that how it works if somebody were to actually create the insurance with your help?
Yeah, correct. So I work with a team of people. Depending on what you want to do and how you want to build it is going to be depending on the consultants that we're going to put you together with. I believe that when you're dealing with things like IULs, whole life bank policies, things of that nature, I like to bring in a team. 2 eyes are better than 1. And I do that so there's checks and balances, so nothing ever gets messed up, because we're talking about the expectation of life and death, the expectation of beneficiaries and legacy built on generational wealth, and the expectation of investment of money. So I always like to make sure that all those I's are dotted and all those T's are crossed to make sure that we don't make any mistakes. You see, we like to measure 2, 3, 4 times before we end up cutting. We're not a one-sit-fit company. There are way too many internet-driven companies, Instagram-driven companies where you call a phone number, they spend 30 minutes on the phone with you, they hard close you and put you in a product. That's what I call a one-sit-fit. That's not what we do here at ProCare. We take a very, very consultative approach and we slow the process down. So not only does the consumer and the client really understand what they're getting into, we also want them to understand how to leverage the policy to get the full amount of power out of it, whether it be mitigating the risk of long-term care, mitigating the risk of not being able to work for 2 years because you've got a dread disease and they have to see you to get treatment and things of that nature, because a lot of these treatments aren't accepted by insurances and the insurance company's not going to pay for it. But if they can access the money within the policy, then they're better suited to get the treatment that might actually cure the problem that they have and not just mask what's going on, mask the symptom. So much of our medicine today, I think, is masking symptoms and not really solving things. And because the government doesn't approve it or insurance companies don't approve it, a lot of clients feel stuck. but they don't know, hey, I can access my life insurance and get money out of this to help me get better if I have a dread disease, which a lot of immune deficiencies are dread diseases or chronic illnesses or critical illnesses. So I think that's a really huge thing that people understand, that there's a massive power that exists, and we try to help navigate that for people and put together a strategy, because anybody can get a plan. At ProCare, we give you strategies that you can utilize both in life and in death.
Well, that's excellent. Yes, we do work with a lot of people who was feeling fine all the years, and all of a sudden they got sick, and then they're not able to get answers from their doctors, and the insurance that they have is not helping them cover any costs. So I think that's a huge benefit of setting something like that up. So I think you covered that earlier. What should a person consider when choosing a policy? And that's something you and your team work together to help figure out that.
Exactly. Like some of the things that I would tell you right now off the top of my head. Now, of course, because of our approach is very custom and our approach is very tailored, we always have a very specific way that we approach people. But realistically, after we do a financial analysis, we always do a financial analysis, not without being, too prying or nosy, but we're talking about money and you being able to afford a policy. We don't want you to be starstruck, right, and buy a Bentley when you have a Toyota budget. Like, that doesn't work, right? And I see so many people that do this. This is why the turnover and the chargebacks in life insurance are so high, because people are very good at sales and sell somebody into something they can't afford. Because you can afford it now does not mean you can afford it later. Maybe you got a bonus and you're sitting on $25,000 extra and you think in your mind, oh yeah, I've got all this money, I can afford this. Well, no, you can't. You can afford it now, but you can't afford it 5 years from now. What's your budget? What's your living expenses? How much do you pay for mortgage or rent? What are you paying for your car? What are you paying for your car insurance? What do you pay for your health insurance? What do you pay for utilities, gas, electric, water, cable, internet? What do you pay for those things? Do you have children? And if you have children, are they in private school? And if they're in a private school, what's that tuition look like? How much is that costing you? What are you paying in school supplies? What are you paying for tutoring? What are you paying for the grocery store? How much are you spending when you go eat out? What is the monthly budget? And then how much are you making? How much money are you making after taxes? And we look at those two numbers and we subtract one from the other, and it lets us know what the excess amount of funds is available in the household. Sometimes people are surprised to find out they've got a $3, $4, $5, $10,000 extra every month sitting there. And they're like, well, hold a second, I don't feel like I have that. And I'm saying, okay, what are you spending that money on? Because we just went through all of your expenses and you didn't list those things. So if you're making less money, something's got to give here. How much Starbucks are you drinking, right? How many subscriptions are you with online? Like, how much money are you wasting on things that really don't matter? And if you were to put that in perspective, what would you rather have? Protection, generational wealth, legacy, or that tangible item that gives you that small amount of dopamine release just right now, just leaving you to want more and more and more and more? How many suits do you own? How many shirts do you own? How many purses do you own? And at the end of the day, none of that stuff goes with you, and your kids probably don't want it anyways, right? So what's that tangible item that you're going to leave behind, what really matters? So we do this financial analysis, but I would tell you right now, everybody should know what their budget is. How much money do they need to be financially secure, right? And that's the other side of that question. And so many people misunderstand that. No, financial security is being able to pay your bills without working, right? That's financial security. Pay your bills, live the life that you're currently living right now without a job or making active income. Like, what's that passive income coming in? That gives you financial security. The other step is the financial freedom. But the financial freedom, once we find out what people want there, that's when we can start tailoring things, saying, okay, this is what we want to do. You want to take X amount of dollars and you want to put it in here. But also important to know is if someone's already investing. A lot of times I run into people and they're like, no, I don't participate in my company's 401k. And I'm like, why? And they're like, because the stock market's crap. And I'm like, I get what you're saying. But is the company matching you? And they're like, well, yeah. I'm like, well, then that's free money. You should probably take that. You should probably invest in that. But you can only invest so much money into a 401k or a Roth IRA. So whatever's left over is really what we're looking at. So we do a really good job to carve out all the things that they need to have and then see if the strategy of an IUL or a whole life policy will work for them. And there's a big difference between the two, because if you don't have tons of money to just lump sum into something, IUL is the best way to go. So 90% of people were putting into index universal life strategies. and we maximize the cash growth and minimize the death benefit growth. That way you got more money going to cash, less money going to death benefit, unless you're trying to move larger sums of money. Because we keep it under something called the MEC, which is kind of a financial ruling that the government comes out with that you can put into one of these products without being taxed. So we always pay attention to the formulas to make sure that whatever we do, we're building you a policy that's going to last a lifetime and that you won't get hit with any taxes whatsoever. And it also won't what we call cannibalize. And this makes it a little bit confusing, but when people carelessly build one of these IULs, there comes a point in the lifetime of an IUL where the life insurance will start to eat the cash value, and you'll start to lose money in the cash value because of inflation and someone not properly strategizing this policy. This is why I use two people whenever we build these policies, depending on the size. If they're much larger and we need to involve a trust and things of that nature, we bring in a lawyer as well. So sometimes it's three people. Really depends on the path that you want to go down and how intricate you want it to be.
Wow, I never had anyone explain it to me like that. So I really understand better how it works and how it can help people. So is there anything else that you feel like you would like to share? Let's say somebody who knows nothing about insurance and maybe they never invested into anything. It's like average person who doesn't have much extra cash. Like, what would you share with them?
So I would tell you right now, for someone that's never really been, into investing, or they don't really have a big know-how, you don't want to start trading stocks. You don't want to be like, oh, well, Tesla's down and someone said to buy Tesla, so I bought 5 shares in Tesla for $175 a share, and it might go up to 200 and then I'm going to make all this money. No, you're not. You're going to make $25 per share, and 25 times 5 shares is not a lot of money. It's not going to move the needle. So what you really want to be looking at is compounding interest and getting into something that will spark the interest to start to learn more. And IULs are a great way to do that because you're not going to participate in any losses. So that money that you're earning and the money that you're putting in, it's not at risk of being lost. You only run the reward of it growing over time. Also, the next thing about IULs is that you want to be patient. When you're putting these things together, you want to be patient. And the third thing that I would tell people is when people are talking about be your own bank, right? Be your own bank, grow your own bank, become a bank. That's what they're talking about. They're talking about 2 different policies. One is a whole life policy. This is if you have lots of money and you can dump it in there and you get a solid percentage. It doesn't go up and down. It just stays the same. But if you don't have a lot of money and you're trying to budget, what you want to do is do an IUL. It's going to grow faster that way. And it's going to give you more advantageous areas of growth. And that's just really the best thing about an IUL. But the point of that is you can borrow against this money and make major purchases. So I love building these for kids. And that was the big subject that I talked about at the mastermind is how do I want to impact, because I believe in impact, how do I want to impact the next generation? And I thought, well, the best way to do it is with children. And the reason I love doing this with children is that you can put an IUL on a 2-year-old. And people are like, wait, what? And I'm like, yes. Some people are like, well, you have to own an insurance policy, don't you? I said, no, depends on the company. Every company is different. And I deal with over 96 different companies. So we've got plenty of different companies that we can choose from to find the right strategy. And when you build an IUL on a child, you're really setting them up for an unbelievable future. And I'll give you a great example. I have a 2-year-old. I built an IUL on my 2-year-old, Audrey. And when Audrey is 18 years old, she's going to have some $300,000 in this policy. That's the way I built it. So when she's 18 years old, she's going to be able to borrow against that $300,000, which means that if she wants to buy a car, she doesn't need to go to a bank. She will not need to get a loan from a bank. She will not have to pay a bank interest. She won't have to pay an insurance company gap insurance and have all this other ridiculous stuff that you have to pay when you actually get a car. So what she can do is borrow the money from herself and then make the payments back to herself, thus compounding the interest and not paying taxes on that money. Then when my daughter's old enough to where she wants to buy a home or buy a condo or an investment property, maybe she goes to college, right? I'm not necessarily sure that my daughter's going to go to college. She might be smart and become an entrepreneur. I don't know. But if she does go to college, well, then she can take that money, that 300 grand, and say, well, listen, this is what I'm going to do. I'm going to buy a 3-bedroom apartment with the money inside of my IUL. And then what I'm going to do is I'm going to charge rent to my 2 roommates and have them pay me money. And then I'm going to take that money and put it back into the IUL and compound the interest and have an actual asset that I can own and go to school. And when she gets out of school, she could move, take the money that she's paid back into the policy and buy another property. And now she's got 2 cash flow properties that she did not have to go to a bank to use. Now, the other side too is by the time my daughter is 65 years old and she's ready to retire, she's going to have just shy of $4 million sitting in this account. $4 million that she can then borrow against or convert it to payments for life. And it still has a death benefit. The beneficiary of this policy is a trust. The beneficiary of the policy, obviously my daughter's 2 years old. She doesn't have kids. So the beneficiary of the policy is a trust. So my daughter passes, it goes into a trust, and the trust disperses the money out to the next generation. It's an irrevocable trust. It's a very important part of the factor of generational wealth and becoming your own bank. But these are huge things that people need to think about. If not for you, what about your kids? Because at the end of the day, the reason most people get life insurance is so they can leave something for their children. Build the policy on the children. The price of the death benefit is much lower on a child than it is on an adult. So you can put a lot more money into the cash value and grow these things exponentially quickly. Then your kids can enjoy them during their lifetime. They don't have to wait for you to die. And you give them an unbelievable idea, life, and education as they're growing up. You teach them to be their own bank. You teach them to leverage credit. You teach them to leverage money and leverage interest rates and leverage tax-free vehicles. And that grows into a smarter generation coming into the next play. Let's change the 1% to 2%, right? It's been 1% for too long. With things like this and ideas like this and teachings like this, we can change the fabric of how wealth is grown in America in more of a passive way where everybody can take advantage of. And that's really where this all stemmed from. So I love doing this for children. And of course, I love doing it for adults that understand what they're doing and have the patience and the fortitude to move through this and continue to put their money into these programs. But it's really a blessing of a product. We absolutely love it here at ProCare. And I have a great partner that I do this with. His name is David Frederickson. He's an amazing person. He helps me with the majority of my policies. I don't know if you ever met David before. David's a great guy. But yeah, that's basically what we do. We absolutely love doing these things.
Great. And our dad came to the United States in his 40s. I think he was 45 or 47. And he only came with $300. So he wasn't able to create that for us because he only had $300 and he had to work. But he worked really hard, learned English. He was able to buy a house within like 4 to 5 years of living in the United States. And then we also came to live here. So I think if we had access, or my dad had access earlier on, we would have been in a better place to pay for our education and many things that we wanted to invest into. So I think that's great what you're doing. Yeah. And also, what would be the best way to contact you, to have a meeting with you, to schedule a meeting with you? How does that work?
That's a great question as well. The absolute best way to get in touch with me is actually through my assistant, Kim. And it's kim.procare1@gmail.com, or you can just DM me on Instagram, right? FT Lunds is my personal Instagram account, or pro_care_consulting is my Instagram. That is the best way. Either DM me or message my assistant and she'll put you on my calendar. My assistant handles my calendar. She gets everybody on my calendars. I run appointments basically 6 days a week. I have openings throughout the week. Sunday is my Sabbath, my Shabbat. I don't do anything on Sundays. I relax with my family. I take leisure on that day. But most every day, evening times, morning, afternoon, I have opening slots to discuss these things with people. I coincide with my partner, David, and we really come up with great strategies for people. But it's very easy. You can just message my assistant, or you can email me at Filip@procare.consulting, or you can follow me on Instagram, FT Lunds, and you can just DM me on there.
Excellent. Well, thanks so much for sharing your knowledge and your expertise. And I'm really looking forward to share this with more people who I believe everybody needs to talk to you.
I love it. Thank you so much. I really appreciate being here.
You're welcome. Thanks for joining me.